Hello, everybody. Thank you for coming today. The presentation defense of the dissertation of Michel Gabor. I want to thank first the other committee members. I'm Mariam Premti, the dissertation chair, but I want to thank the other committee members, Mohammed Jafarinejad and Rashida Kamal, Praveen Parvatia for the support of the DBA program and creating this amazing program. And Michelle for her amazing work. She's done a really good job, and I'm looking forward to see the presentation. The title, Regulatory Impact of U.S. Financial Institutions' Financial Performance.
Thank you.
Without further ado, I'll leave the floor to Michelle. Thank you.
Thank you, Dr. Premti. Thank you, everyone, for being here. You already have the title, so we're just going to go quickly through the agenda for today. First, to start with gratitude. Thank you is inadequate to express my appreciation for all the support I've received from my committee, Dr. Premti, Dr. Jafarinejad, Dr. Kamal, Dr. Parvatia, in support of the whole DBA program. My parents who are here and my husband who is here have been incredible in putting up with my crazy schedule and stress, and constantly, everybody in this room is constantly reminding me that I could get here and has helped me do it. So thank you. Thank you also to all of my other cohort members who have been so supportive, my colleagues at the University of Wisconsin-Parkside who have been very supportive, and the rest of the family and friends who have been great. So we're going to start with the intro. Is the sound okay? Yes. Okay, thank you. We start with just a brief intro, overview of the motivation for the study. Then for each study, I'll go quickly through the literature review and research gaps, talk about the research questions and contributions, talk about the hypotheses. I have a lot of hypotheses, so it's going to be very brief, because we want to spend most of our time going into how I did the work, the research methods, discuss primarily the results, limitations, future questions, or future research questions, and then get questions and have more conversation with all of you. So why these studies? Study 1 is talking about the U.S. low-income designation for credit unions, and finding out the impact on the financial performance. Study 2 is looking at the impact of overdraft protection reduction on U.S. bank market valuation. Very roughly, this reflects a broader interest I have in looking at how technology, people, and financial institutions interact, what happens to financial institutions as the financial service environment changes, as well as the regulatory environment that's continuing to go through changes. Why these studies? I have a background. Oh, boy, I can't do that. I have a background in financial institution management, having worked multiple positions at a large credit union. And I've actually lived through a lot of these experiences we're going to be talking about. I was working at the credit union when we got the letter telling us that we were eligible to be a low-income designated credit union. And honestly, we all looked at each other and said, what does that mean? So that's interesting to me. I also have lived through that time working in a financial institution where we went primarily electronic with payments, and that's tied directly to what's happened with overdraft protection. So study 1, the low-income designated credit union, in the broadest sense, is talking about financial inclusion. The regulatory bodies and legislatures in the US, as well as a lot of other NGOs, have decided that financial inclusion is a good goal. We want people to have good access to good and fair financial services. So the regulators incentivize financial institutions to try to have them offer services to the underserved. So the US credit union industry is unique. It's different from banks because all credit unions are nonprofit financials. So they're all owned by their members. You know, banks, you might have private ownership, public ownership. We don't have that with credit unions. They do, however, exist in that same increasingly competitive marketplace. Credit unions compete with banks, compete with PayPal, compete with every mobile app that we all see all of the time, online banks, everything. And they also have similarities in that economies of scale are related to profitability and good financial performance, of course, because they help them be efficient. And also, we know that asset quality has a big impact on profitability and risk for all financial institutions. To give a little industry context here, you might not be familiar with credit unions. So we want to see that from the period of the study from 2000 to 2020, we've had incredible growth in the credit union industry in the United States. Total assets in billions are just over 1.84 trillion. They've grown 320% in the 20 years. The membership numbers have increased by 60% in that same time. Notice here we got about 124 million credit union members. That's roughly a third of the citizens in the United States. So we're talking about a systemic importance that credit union industries have. We also see a decline in the number of credit unions. Like banks, there's a lot of mergers, especially after the 2008 financial crisis. In this time, the number of low-income designated credit unions, LIDCUs, has increased from only 645 to 2,642. And in 2020, over half of the credit unions had the designation. A lot of this is because the NCUA, the regulatory body, National Credit Union Association, has changed the guidelines to make it a lot easier for credit unions to get designated because they want to encourage that service to low-income membership bases. So the gap here is that we know a lot about financial institutions, some about credit unions, some about financial inclusion, but we don't know what happens when an institution is focused on serving an underserved population. The regulatory body and some non-empirical research has indicated that there will be higher costs, higher credit risk, lower growth potential. So a lot of the common knowledge or common sense says that it would be a negative for financial performance. But we want to find out for sure if that's the case, right? What we do know about the low-income designation is that it's developed and again expanded to almost half the credit unions now. In addition to providing some training and technical resources, low-income designated credit unions are eligible for statutory waivers or benefits that most credit unions don't have. So most credit unions can only lend out up to 12.25% of total assets in business loans because they're considered higher risk. Low-income designated credit unions can lend out more than that. Also, most credit unions cannot accept non-member deposits. Most of the time, they can only accept deposits from their member owners. But low-income can accept non-member deposits as a statutory relief. And perhaps most importantly, low-income designated credit unions can obtain secondary capital. For most credit unions, their only source of capital are retained earnings. They have no way to issue stock, get additional capital. So we're also going to find out what the impact is of those. So our two pretty straightforward research questions. Question one, what is the impact of the low-income designation on credit union financial performance? Two, then, what is the impact of the regulatory waiver usage on credit union financial performance? So we want to extend the academic literature by empirically testing the association of LID and the waiver benefits with multiple financial performance measures. There's been a little bit done here and there with some aspects of serving the underserved, but not a whole-scale empirical look. We also want to advance knowledge basically of financial inclusion initiatives in this country, the implications for survivability when institutions serve the underserved, and then also the implications of this secondary capital, question, because in 2022, the NCUA announced that credit unions who have over $500 million in assets can also obtain secondary capital. So it's not just low-income credit unions who are going to be able to access secondary capital moving forward. So we can get some really great information here. So here is the chart of the hypotheses. I'm going to go through them pretty quickly. We can come back to it if anybody has specific questions at the end. We have basically 5 different measures of financial performance that we want to look at. Profitability will be measured by return on assets and net interest margin. Risk is measured by credit risk that the loans won't be repaid. Growth is measured by asset growth, A growth, and M growth, which is membership growth. And it's important to remember here just one of the distinguishing elements of the credit union is that their primary stakeholders are their members. So their goals are growth and sustainability and positive rates and fees for their members. I've turning my back on the audience, that's great. I have hypothesized the direction. In most cases, we have counter because this is new. Research. I have where I can see it could be either a positive or a negative relationship between LID having the designation, and then we also are going to measure the use of the business waivers that we talked about earlier, business loans, secondary capital, and non-member deposits. So how did I do this work? I obtained all the information as secondary data, annual data from 2000 to 2020, on all US federally insured credit unions. All financial institutions in the US have to file quarterly call reports. This information is available on the regulators' websites. And I also filed a Freedom of Information Act request with the NCUA, requesting the LID effective dates. While the call reports will tell you if a credit union has the low income designation or not, it doesn't tell you when they obtain the designation. This led us to a full sample of 50,328 observations over those 20-year periods that covers 3,578 credit unions. It's not a balanced sample or balanced panel because some credit unions merged, some closed, some opened during that time frame. So here's the summary statistics. Again, I just want to show this quickly and also have it available in case we want to look at any of the details later. So for these first two models, measure our first research question, basically what is the impact of LID on credit union financial performance. In here, I have two different specifications of the model. The only difference between the two is one is using LID, which is a categorical variable. 1 if the credit union has the LID, 0 if it does not. The second model is using years LID, which is measuring the number of years that the credit unions had the designation. So year 1 is the year of designation, and so on, because we also want to see if it makes a difference in performance the longer the credit union has, has the designation. Again, one moment. Financial performance, we have the 5 different measures for: profitability, return on assets, net interest margin, credit risk, and then growth in both asset and membership growth. Describe the variables. And then for our control variables, these are very common in the literature. We use the log of total assets to measure size, the capital ratio, which is net worth divided by assets, loan to asset ratio, which measures sort of that traditional intermediation role that financial institutions play, and then the age, and how long the credit union's been open. Now for the second set of hypotheses that are related to our second research question to determine the impact of benefit usage, we go instead to this model where our primary IVs of interest, independent variables of interest, are business loans, secondary capital, and non-member deposits. Those are the things that low-income credit unions can do that most other credit unions are statutorily prohibited from doing. We also have 2 specifications for this. We have a categorical variable where 1 is the value if the credit union has member business loans or secondary capital or non-member deposits. We have an alternate specification where I take the balance of that if the credit union has member business loans, take the balance and then use that as a ratio of total assets. Because in that specification, we want to see, does it make a difference on financial performance if the credit union uses more of of that source. And I should also mention here that we, have, going backwards? Okay. We also have 2 specifications in terms of time. I test both the current year, T, performance, and then also T plus 1, because it might take a little while for the impact to show up when a credit union starts to use something. Especially with secondary capital or non-member deposits, they're getting additional funds, they might be launching a new program or doing something that it'll take a little time for those results to show up. So I'm going to just show, I'm not going to show all the tables for all the hypos, I'll just show one table for each of the research question areas, and then I'll summarize the results for the rest. So we can see here, we have, again, we had to measure LID and years LID separately because of multicollinearity issues. But in both cases, there's a positive relationship between the low-income designation and return on assets. So that's great news. There's also a positive relationship between the years of low-income designation and return on assets, which means that that positive effect or positive relationship persists through time. I will get into later also the control variable results and address those together. Then in terms of the benefit wafer usage, here I picked a different example, wanted to show what happens with credit risk when credit unions use the regulatory waivers. And as we would expect, just because of finance theory, if you take on more risk, you have more return. We saw that ROA tends to increase, so we should expect to see a higher credit risk because it would be logical to go together. And we do in fact have that. Business loans as either a dummy variable, if they have business loans or not, and also a higher percentage of business loans as total assets. Both of these have positive relationships with credit risk. Secondary capital also has positive relationships with credit risk. Non-member deposits also has positive relationships with credit risk. So it just means that when credit unions use these waivers, they're going to have higher risk of not being paid back on loans. Again, this is not a bad thing. It just is something to be aware of. As credit unions are serving the underserved, it is true that they are going to see higher risk. We have empirical knowledge of that versus just expecting that that would be the case. Okay, so here's the summary results. Again, we can come back or go through any questions anybody has about these in more detail. But basically, what we found, in the most cases, what we found was as predicted. There's a positive relationship, again, as we just saw two slides ago, between ROA and low-income designation. Also, net interest margin tends to increase with the low-income designation, which we expected. This happens because credit unions will charge a higher rate of interest to higher credit risk. Usually people who are low income have less assets, lower credit scores, so they're going to pay higher interest rates for the same loans. There's still going to be fair interest rates, and any credit union advocates would say that they're lower rates than other sources of loans for low-income people, but they're going to be higher interest rates than what somebody with a very strong credit might pay. Also, when LIDs use business loans or non-member deposits, they tend to see improvements in ROA. This tends to help their profitability as well. Secondary capital, though, doesn't help profitability, is what our findings suggest from this study. Secondary capital is negatively associated with profitability. Again, this isn't bad. It just means that maybe credit unions are obtaining secondary capital because they want to invest in some programs that they know might cost money, but they're still within the mission of serving that underserved population. In terms of the net interest margin, surprisingly, I thought business loans would have a positive association because typically business loans make higher interest rates than consumer loans. But the other aspect of this is that if a credit union is using business loans over the capital or statutory limit, they have a large loan portfolio, member business loans. They may have a lot of efficiencies there. Therefore, they can charge a lower interest rate to their members on those loans because they've gotten very efficient at it. Again, we go back to that economies of scale that we talked about earlier. And again, credit union mission is not to make a bunch of money for stockholders, it's to provide good rates for their members. Secondary capital is primarily non-significant, except for in the subsample that is beyond our scope and the time that we have today. And for non-member deposits, that does cause a decline in the net interest margin. This makes sense because non-member deposits will typically be something like a certificate of deposit that's issued to non-members. And those are usually going to pay a higher rate of interest than a credit union might pay to, on their savings accounts for their members. So it makes sense that the net interest margin would be lower. Credit risk, again, we went through this and saw that there were increases in credit risk across the board. Now, one of the things that the National Credit Union Administration and CUA, the regulator, really is concerned about is that they predict that low-income credit unions are going to grow more slowly. But what we see here is that LID is associated with positive growth, both asset growth and membership growth, and also that using the regulatory waivers is also positively associated with growing the credit union. So that's really for a credit union, what keeps it vibrant is it's growing, its asset base and also membership base, so it can continue to be profitable going forward. In terms of the control variables, these results are really, in most cases, it's very consistent with prior literature. Size is just good for financial performance in general for organizations. They tend to be more profitable, have lower credit risk, higher growth rates. The capital ratio or the net worth ratio is slightly mixed. This also tends to be higher with ROA, or profitability measures ROA and net interest margin. There's a negative association between credit risk and capital, and we can talk about that in more detail in the questions if anybody really wants to get into that. Asset growth and capital actually is a negative relationship. One prior research has ascribed this to potentially very highly capitalized credit unions who have a lot of savings built up might not be as aggressive in pursuing further growth because they're more concerned about their safety. Loan to assets, this here, again, this gets back to that primary financial intermediation activity where people put in deposits and then the institution makes loans. And that's what the intermediation activity is. And that's when financial institutions have the strongest performance. So a high loan to asset ratio means that the credit union is primarily involved in lending money out, and that's very highly correlated with positive financial performance. The age of the credit union, these are also typical in terms of lower profitability as the credit union ages, lower credit risk as the credit union ages, also lower growth rates. And a lot of this is due, again, to that membership formation for credit unions. They have a certain membership base that they can't expand beyond. So if they're older, they may have really high penetration in their membership base, and they just can't really grow very much, which reduces their ability to make money. Net interest margin, though, this was supported by a finding in bank literature that found higher net interest margins were associated with older banks. So to summarize here, We have extended the knowledge of financial inclusion initiatives in the United States and how those financial inclusion initiatives affect, in this case, low-income designated credit unions. And basically what we find is that it's kind of a win-win. The LID does not diminish profitability or growth despite higher credit risk. Credit risk just needs to be managed. And the regulatory benefit usage has some positive relationship with financial performance, again, despite needing to really watch that credit risk and just have a carefully managed program for the credit union. Some limitations. Probably the primary one for this research is that we don't know the extent of the low-income membership base. So for example, a credit union just needs to have 50.1% of their members low income to be designated a low-income designated credit union. There could certainly be a difference between a credit union who has 50.1% low-income members and a credit union who has 80% low-income members, for example. So we don't have a way of getting that data. We also are a little bit restricted because I was only able to get the designation date from 2000 after the NCUA wasn't able to provide the information for credit unions who got the designation prior to that. But that helps us to look at future research because as the designation has grown in popularity and as we see other applications of waiver benefits, for example, obtaining secondary capital for large credit unions, there's great opportunities to see as more credit unions use these waivers, what happens. It's also a great opportunity to potentially extend this and look at, say the Community Reinvestment Act for banks, see how that impacts their financial performance, and then, even potentially look at other countries whose governments also incentivize financial inclusion efforts. All right. Okay, on study 2 now. Here we're going to switch. We're going to stay within the United States. We're going to stay with financial institutions. We're going to stay with financial inclusion, but we are going to switch to public banks and talk about overdraft protection reduction. So what is overdraft protection? It's, if anybody remembers, in the old days, you wrote a check to pay a bill, and if you didn't have enough money in your checking account, the bank might cover, or credit union, might cover that check, and they would charge a fee called the non-sufficient funds fee. Well, overdraft protection is basically that same fee, but it's assessed on electronic transactions. So it's assessed if you use your debit card or your ATM card or authorize an electronic bank withdrawal, and you don't have enough money in your account. It is been perceived as being problematic due to its opacity for consumers. So as it shows here, some people will say it's consumer choice. If people want to have those transactions covered because they want to spend the money, that should be their choice. But others say it's consumer exploitation. The average fee in the last 20 years has been $27 for overdraft protection, and that can really add up quickly. There's a lot of stories about people paying hundreds of dollars for a cup of coffee because they didn't realize how the fees worked and how they would be charged. So there have been movements to reduce the overdraft protection fees. In 2010, there were opt-in rules for that consumers had to say they wanted to pay that fee if they had non-sufficient funds in an electronic transaction. Also, the Dodd-Frank Act, one of the many things the Dodd-Frank Act did was created the Consumer Financial Protection Bureau, and that brings us to our more recent period that we'll be studying in this paper of the Consumer Financial Protection Bureau launching a really big investigation and putting a lot of attention on this matter, saying that consumers are being unfairly charged overdraft fees and having a lot of issue with the programs. There's also been some legislative activity around overdraft. And in response to some of that pressure from the legislators and regulators, there are some banks who have started to voluntarily reduce their overdraft protection fee income by either eliminating fees or enhancing their programs, which could take a variety of forms. So we have this time where we have this really interesting thing of both regulations and voluntary bank reductions in overdraft protection income. So what do we know about this? Well, in the big picture, there's been a lot of research, great research done about bank valuation and the response to regulation. Mostly that's been in relation to systemic safety type regulation. But we do know that uncertainty of any kind has a negative impact on bank stock prices. So basically, if investors are hearing that there might be rules that change regarding financial institution regulations, there's typically some reduction in stock prices for banks. We also know that following the financial crisis, investors became more concerned about compliance than they had been prior to the crisis, when they were more focused on earnings. Now, when we go more specifically to, so it's basically the systemic risk type of regulations, which have been heavily studied. When we go to regulations that increase consumer protection, those haven't been as widely studied. There's actually some calls for future research. But what has been found, especially in recent years, is that banks are becoming increasingly concerned about the media coverage because they see that changes consumer awareness of their practices. They're paying a lot more attention to what's being said about them in the public space. Compliance costs tend to increase when new regulations are announced for any organization. Another thing that we know through recent studies is that when consumer protection regulations are clarified, even if that's making them more strict, then it reduces the risk that a company is going to run afoul of those regulations and get fined. So whenever regulations are clarified, that tends to reduce the legal risk for institutions because it's easier for them to follow the rules when the rules are easier to understand. Now, in terms of the importance of bank non-interest income as a revenue stream, there's been a growing reliance due to compressed interest rate margins for the last 20 years, excepting the last year and a half. And banks have become increasingly reliant on those overdraft fees for part of their non-interest income. ODP fee income revenue is higher than any other bank checking account related fee, to the tune of about $15 billion in 2019. So that figure is part of the reason this has come to the attention of legislators and the Consumer Financial Protection Bureau, because that's a lot of money that consumers are paying for something that maybe doesn't make sense to them. Largest banks also have disproportionate ODP income and higher per item fees typically. So I said it earlier that some banks are voluntarily reducing their ODP income. Why would they do that if they rely on it so heavily? Well, reputation risk management would be one of the key reasons. There's starting to be a lot of pressure from the CFPB and others. Reputation risk management has become increasingly important to banks as well as many other industries. And there have also been studies that have found a positive association between corporate social responsibility activities and bank financial performance. So there's some empirical evidence that doing good, socially responsibly, does improve bank financial performance. That could be another reason for their interest. So this leads us to our two research questions. Neither of these has been studied previously, specifically to overdraft protection in the US. And again, there's been very little study for consumer protection regulations in the US. But question one, what is the impact of potential overdraft protection regulatory change on banks' valuation? And the second question, what is the impact of voluntary individual bank overdraft protection program changes on their valuation? So basically we have the regulatory environment where the whole industry is being suggested that there may be changes, and then you also have individual banks who are announcing changes. This again is really going to extend the body of knowledge regarding how consumer protection regulations affect bank valuation. It's also going to give us evidence regarding market valuation impact of announcements concerning sort of the S and ESG initiatives. E is environmental. There's been a lot of research done on climate impact and things like that, and market valuation. There's been a lot on governance, the G in ESG, on how governance affects valuation and firm performance. There hasn't been as much in terms of the social aspect, and something like this, where you're looking at consumer protection, would fall under that social aspect. There are also implications for non-bank payment service providers. Again, in this increasingly competitive environment. PayPal, for example, you read their annual report. PayPal comes out and says, we're not regulated like a bank. Here are some of the things they're talking about doing in banking. If we were to become regulated like a bank in the US, we'd have much higher costs, and we'd have to change our policies a lot. So there are also implications for other financial service providers. So our hypotheses here, the first ones are related to those regulatory reduction announcements. And we have a hypothesis and a counter for each of these situations. Basically, H1A, we say that these regulatory reduction announcements would reduce bank valuations. The primary reasons for that would be fear of earnings decline. Also, that financial regulation policy uncertainty that we saw before, just knowing there might be a change, may negatively impact valuation. On the other hand, though, the regulatory overdraft protection reductions could be positive for the bank industry. Investors may see a reduction in reputation risk with, again, clarified laws and what might be considered to be more fair treatment for consumers. And there's also proof that there could be reduced legal risk, which is associated with positive valuation based on different tighter regulations, more clear regulations. Now, our second question, we wanted to find out about the bank voluntary overdraft protection reductions. And here again, we have two hypotheses, H2A, reason that the reduction may be associated with reduced bank valuation, concern about earnings decline. It could also sort of be counterintuitive to the banks that they might think they're announcing something positive. However, people might see the announcement and think about, all these profits that this bank has made with their prior unfair practices and kind of have a bad taste in their mouth, the reputation management issue. H2B, we say that the voluntary big reductions might be associated with increased valuation. It comes back to signaling theory, where the bank is saying we're so strong that our profits will not be damaged by this. We can afford to reduce our fees. And also might be saying we're better aligned with our stakeholders. We're looking at a flip side of reputation management risk there. We have, I have an additional hypotheses related to bank characteristics, a cross-sectional analysis of that. In the interest of time, I'm kind of just scroll through these, but we can come back as we talk about the results and go through them. So in terms of methods, we have the invent dates. I identified dates where regulatory, the CFPB period just refers to CFPB or regulators announcing potential changes to overdraft protection policies. And then there's a voluntary ODP reduction where I researched to identify banks who had made announcements of overdraft fee reductions. So a total of 290 banks total that we evaluated. 52 banks had voluntary ODP reductions. I should backtrack. We started with all US publicly traded banks who had over 100 million market cap as of December 31st, 2021. So it's right in the middle of all these event dates. Also uses CFPB's top 20 list. The Consumer Financial Protection Bureau keeps a list of the top 20 highest earners for ODP fee income. That could be probably more interesting to see what happens with those firms in terms of reputation risk. And we obtained the data, do the event study in words, also obtained data from CompuStat, and obtained data from bank call reports, because ODP fee income is not reported separately on firm quarterly filings, but it is reported separately on the call reports that they submit to the FDIC. Here's our summary statistics, just to show. And again, we'll go through, we do the event study is basically, what we want to do is just go through and look at the return of the banks on the day of the event. So say that an announcement's made by the CFPB that they're going to take this more seriously. We look at the event day, compare the bank's return to the overall market return on that day. And then through the magic of Stata, we do a whole bunch of calculations to come up with the cumulative abnormal return, which is the total of the bank portfolio difference to market. So if the bank's returns were the same as the markets on the event dates, then the cumulative abnormal return would be zero, would equal zero. It would mean that there's no difference between the bank's performance and the market performance. So we're going to do a t-test to find out if the CAR is significantly different from market returns. So that's for the first test. For the next test of our hypotheses, we're going to do a more traditional regression analysis where we just look at all the characteristics of the banks and how that affects their returns. And this describes all those. So getting to the results. We do find that there's a significant difference in the returns for banks in both of these time periods. So here we'll see that when the regulatory events occur, bank valuation is higher by an average of 0.0224 than the market. So when regulatory events occur and announcements are made, the bank stock outperforms the market. Here we have the t-value, so that is a significant value. It says, and this is p less than 1%. For voluntary events, when banks announce that they're reducing their overdraft protection, that has a negative association with bank stock valuation. So when the whole industry is going to be affected, it's a positive effect on market valuation. When one bank announces, it tends to be a negative effect on their market valuation. And that's significant at t minus 2.127 and below 5% p-value. Here's our cross-sectional results. And what we find, the first three columns are showing the results for the regulatory events, the CFPB CAR, and these three columns are showing the relationship between bank individual announcements and returns. So these three are regulatory, these three are bank individual announcements. And these first three rows here are really related to the bank's reliance on traditional versus non-traditional activities. So you have to remember, we were talking about the credit unions, that traditional intermediation activity of loaning out funds that are deposited. That would be represented by loan to asset, high loan to asset ratio, and net interest income, NII, represents banks' reliance on non-interest income. So that's why these are inverse of one another, because one is very heavily reliant on non-interest income, the other is heavily reliant on interest income. What we see in the regulatory environment is a combination of these, a low reliance on non-traditional activities is related to lower valuation. So basically what that means, when it's a regulatory event announcement, if a credit union is heavily engaged in non-traditional banking activities, they will have higher valuation. It's a little bit to walk through. And then it's the opposite for when the banks make the individual announcements. The ones that are more low reliance on non-traditional activities tend to have better. So basically, banks that are more involved with loans than non-interest income do better in the individual announcements. And in the interest of time here, I'm going to go through it just to summarize, and again, we can come back to anything anybody wants to talk about in more detail. So in close, we did find here that regulatory reductions are positively associated with bank CAR, which is their returns, the cumulative abnormal returns. So it's positively associated. The effect is weakened for larger banks and also banks with higher capital ratios. But the effects are strengthened, or the valuation is higher for banks with higher stock beta and also for banks with higher reliance on non-traditional banking activities. The idea there will be that if a bank is highly reliant on overdraft protection income, it will benefit more from clarification of that of the rules than a bank who isn't so reliant on that sort of income. Bank reduction events have a negative relationship with returns. Banks with higher capital and higher betas did fare better than other banks. More profitable banks fared worse. That's consistent with prior findings where, again, people might look at the profitable banks and get a sort of bad taste in their mouth that they're, doing so well and taking those profits from people. One of the limitations is just around event studies in and of themselves. It's been recognized by many other researchers because there's so much going on in the world. When you do an event study, it can be difficult to know if the cause is actually what you're studying or if it's something else. To help mitigate that, I did full search for other events that could have affected stock price on these event dates and did just excluded a few of the dates I was originally going to study because there were confounding events. In terms of future research, I think this will be really important. We're starting to see overdraft protection fees were being targeted along with other junk fees by legislatures and the administration and the Federal Trade Commission. All sorts of organizations are becoming concerned about these fees that are difficult for consumers to understand or to avoid. So in particular, airlines are being heavily criticized for sort of these junk fees. So it could be interesting for any of these industries that are also under the microscope to realize how changes that affect the whole industry could really affect their market valuation differently than changes they might make themselves. So it's good advice for them, as well as for any overseers and regulators to try to understand what the potential impact of announcing changes might be, and also to see how individual firms in the industry might react to regulatory changes. All right, that's enough for me for now. I'd be happy to take your questions.
All right. Thank you, Michelle. It was a really good presentation.
Thank you.
So, you did a good job. I do have some questions, some comments, and then I'll leave it to the rest of the committee members to also ask some questions. And there are some suggestions also, if you go to present this in a conference or something like that, some tips to take. First, for essay one, I would show all tables.
Okay.
Because you're missing some tables with the results. So have them there, For the sake of time also, if I were to present it, I'd probably focus less on the literature review and more on the results. That's my personal preference, but you need to keep the results there just in case somebody in the audience asks.
Okay.
I had a small question, and there was a summary of the results in essay 1, and there was some asterisks.
Mm-hmm.
I didn't know what that meant.
Oh, the asterisks mean
Even before that, there was another.
that.
Oh, yeah.
So we tested LID and years LID as specifications for under the empirical models. Also tested time period 1 and then a lag of T+1, and tested the subsample of just LID credit unions who've been LID for 3 years or less. Whenever there's an asterisk, that means that there was one result that was not consistent with the others.
I see.
So, for example, for membership growth, the association between LID and membership growth was positive in all cases, except it was not significant in the T+1, the lag.
I see. So the asterisks mean take it with a grain of salt. It's like
Yeah, it means
grain of salt.
that mostly the results were consistent. Yeah, okay. Yeah, okay. Okay. Right. Okay.
And then as you moved on from this, you showed the results, some results for ROA and NIM, but then you kind of skipped through the rest and you went to the summary of control variables. Right? Did we spend a lot of time on this profitability and all this? I don't know. I thought.
I didn't spend a lot of time on.
So yeah, I didn't know, but yeah, I'd spend a little bit more time on this than the control variables.
Okay.
You have a lot of results. Control variables, I'd probably even skip them.
Okay. 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 Makes sense. Thank you.
Now, in the second part, in the event study, I think I may have caught something that I may have missed around the page. The event study, do you run it by hand or you ran it through words?
Words.
So in that case, the model you showed on how it's run, it's wrong because it's shown if it's run by hand.
Okay.
So there is a little, I mean, it should be okay for now, I'd guess, but if you go to time series, to the event study. Up, go back. So it's not run like that. That is if you run a continuous time. The way Words does it is you run an estimation period in the 30 days prior to the event and negative 255 or whatever the parameters you use. So it's like a 3-step process. It's not like a 1-step process. So that. In the next after this, in the t-test, I think it's better to show the p-values rather than t-statistics, because the first one is clearly, but the second one, I don't know where the cutoff is on top of my head, if it's significant at the 1% level or 5% level. So p-value would be more informative. And then again, the same thing here, I'd spend a little bit more time on the results in here than with the other literature review. And now this is a general comment. You probably need to think strategically on this. There's a lot of results and there's a lot more. And you may also want to check with the tenure requirements at your school. Well, one strong consideration could be given to split either essay into 2 papers. So you could get, because I think there is enough results for both. So first one you can use, in the first essay you can use the dummy variables. Second paper could be with the usage.
Okay.
And even here, the first paper could be with the regulation, the second paper could be with beneficial, with a voluntary
Yeah.
announcement.
Okay.
Check with the tenure requirements, you want to start thinking early about that, but that might be a good strategy and also might even help in the publication because a lot of journals don't want papers going 50 pages, 60 pages. So
That's a great suggestion.
it might require a little bit to rewrite introduction and maybe literature review, but I think it pay off a lot more. That's all I had, so thank you. Great job.
Thank you.
Great job, Michelle. So most of the comments I had, Ariane mentioned, so I don't want to repeat them. I think overall you did a great job. I mean, we've been in touch. You had to do a lot of work to be able to put this together. So a lot of tables, and given an hour, it's hard, right? So you have to pick and choose. So it's best to focus on the main results. Control variables, you can always skip them. It's better to have all the tables. So I mean, everything that was mentioned. One of the interesting part. Here also, by the way, since we were talking about this, put the star or p-value, make it easy for everybody to see which one.
Okay.
And here, actually, this result is very interesting because it shows that when you do regulatory forces versus voluntary, regulatory is actually helping versus which. So you may want to spend more time actually on this specific result if you go present it anywhere else because it's surprising,
Surprising.
So overall, great job. I mean, I don't have anything specific. I didn't even catch the words, the model thing, but I mean, we can fix that. So, good job.
Hello, and I'm sorry for being late, but great job. So, talking about this, my first comment, I was just thinking, when we talk about regulatory events, they are like, it's like a big news, right? So, you would expect a bigger reaction around that. But a voluntary event, I mean, like if I own Bank of America, I'm not necessarily following their news every day. And if they make an announcement, I'm not necessarily buying or selling my stock based on that.
Okay.
So I would suggest that, I mean, yeah, because of social media, everyone knows what's going on. Maybe find a story like that and put it in your paper just to kind of, because I can see referees coming back and saying, do you really think this matters?
Oh, okay. That's a great point. And I do talk about, give some examples on the paper, and also the search for the events was a Google search, just on it with the bank name and the term overdraft. So I did find banks who didn't announce, maybe, although they did change their fee structure, they did it quietly, and they're not included.
Yeah.
So, yeah,
And
so
I
there's
think
great
that's something
suggestions to
keep
make it
in
more.
mind. I can see.
Maybe to increase the motivation on that, there is something, not the article of some bank announcement, but maybe some article that says bank X stock jumps or declines a lot after they announce.
Remember, like a few years ago, something happened. I think with Bank of America, they were charging some fee for using the ATM and stuff, or something like that. And people took to social media and said, "We are going to boycott this bank," and that was a huge thing. So
Okay.
something like that.
We can do that because I did cite a paper that studied the Wells Fargo scandal, and their stock price declined 2% on various news dates related to their fines. So I can definitely expand on that. Yeah.
So that was one thing I looked at. And then also, and this is like kind of, just I'm kind of thinking, looking forward. For Essay 1, Model 1, can you please go to that? Where you present the relationship between ROA and LID. Where was it? Model 1, the results.
Oh, the results, sorry. This
Is
one?
it this one? Yeah, I think. So I noticed that how, statistically, it's all looks good, significant, but then the coefficients are so small. So
Oh,
I don't know. Can we do like some economic significance of this? Or I don't know. That's the only thing that kind of stands out. So yeah. So again, just to, get you thinking about this, because I'm sure this is what the referees will come back with. They'll be like, oh, yeah, but
Oh,
does this even matter or whatever? So,
okay, because the coefficients are
yep.
look low. Okay.
Yep. So
Great
those were
points.
my two comments. And then just to kind of reiterate what Aryan was saying. When I was reading your paper, I did see like there's quite a bit of repetition here and there. So when you are sending this out or whatever, you just want to um, shorten the thing. So otherwise, it was great. And I think it's very important. So good work. Yep.
But now you do. Thank you.